Hello and welcome back for December Daily number 2, the 2nd of December. I'm James Wrigley, and as I said yesterday, for those that might have caught my live stream or caught it on the replay, I've challenged myself to try and go live daily through December, maybe the working days in December, Monday through Friday, with a different topic. I've got some guests lined up. A couple of people have already agreed to have it come on live and have a chat with me. So thank you for those of you that have reached out or agreed to join me. I look forward to chatting in a couple of days with you. A couple of guys that have said that you would. If anyone's out there, please let me know you're there. Give us a thumbs up, a like. I am live across LinkedIn, LinkedIn, YouTube, and Twitch today. So giving Twitch a bit of a go. If anyone's out there in Twitch land, let us know. Mina, thank you for joining me. Yeah. So today, I've got a little bit of a chat to go through, but particularly today, I just wanted to have a discussion about. And I think as the title suggests, your investments have done well in the last few months. So now what? This whole COVID environment has seen a whole lot of first-time investors look at investing into the share market, which has been fantastic. A lot of people that I've come across have said to me, "Look, we watched the GFC, we didn't do anything about it. We feel like we somewhat missed out on the drop and the subsequent recovery." From there, there's a few people that I've actually gone on to provide advice to in the last 6 months or so, where they've actually seen markets drop away and saying, "Look, we don't want to miss out a second time around." So I thought I would maybe start with a bit of a history lesson. I'll share my screen here, and I've got. Bear with me if I look over onto the other screen. That's where I've got this graphic. Mark, you're on Twitch. The comments are coming through. Thank you for jumping on there and giving it a go, letting me know that it's coming through. So I just wanted to start with a bit of a history lesson to say, like, what have we been through, and I guess where are we at? All I've done here is just jumped onto the ASX website. Their refreshed website has some graphing capabilities, and there's this graphic here. So this is the ASX 200 for the last year. For those that are unaware, the ASX 200 is just an index of the Australian share market. It represents the top 200 shares on the share market by their size. So it's made up of a fair chunk of the Australian share. Those that are listed on the Australian share market, there are more than 200, but it is the biggest 200. Importantly, you can't invest directly in the index. There are plenty of investments that mimic the index, but you can't invest in the index directly. So there's a lot of index style of investments. But if we go back, kind of February, early March, we all lived through this. We're all kind of forced into lockdown right around the world, caused recessions in most countries, and we saw markets really drop off a cliff. But something really interesting happened thereafter, and it's only, I guess, interesting in hindsight now. There was this thought that as we go into recession, people will hang on to every single dollar that they have. They won't spend. Companies will their profits will really crumble, and things will be quite difficult for some time. What actually happened, though, and it happened relatively quickly, is that because most people couldn't travel, they couldn't eat out at restaurants, those kind of things, that money that people spent on those leisure type activities, traveling and eating out, was just redirected very quickly into other areas. So very quickly, the likes of JB Hi-Fi, Nick Scali Furniture, Afterpay's, been one of the darlings. A lot of these more retail orientated stocks did quite well. So we saw a quick recovery in a lot of those as it became apparent that people were actually willing to spend money. They were spending money on buying computer screens, just like I'm talking to you on now, and desks like I'm sitting at here. So setting up for work from home, buying gaming consoles, PlayStations and Nintendo Switch, that kind of thing, couches, doing up their homes. A few people now looking at transacting and moving house because they've realised that they don't like their particular house for some reason. Hi Graham, thank you for jumping in and joining as well. So that happened very quickly. At the same time, household savings rates right around the world went through the roof. So household savings in Australia in particular had been on the rise for a little while leading into what we're going through anyway. For those with a mortgage, you may be familiar that I've seen mortgage rates probably for the last 5 years or so have dropped. And a lot of those savings on mortgage rates haven't been spent in other areas. So household savings rates were pretty robust to begin with. When we were forced into lockdown and we couldn't do anything, household savings rates went up a whole lot more. And so we saw a lot of people, first time, share market investors, as I said, turn their attention to say, look, I've bought the new computer screen and I bought a new couch, but I'm still saving a whole lot of money. Interest rates are ridiculously low. There's no point leaving it in the bank. What else am I going to do? And so some people turned their attention to investing into the share market. Now, the share market is really just, it's economics 101, supply and demand. There's only a certain number of shares that are on the market. The price of those is just a reflection of demand for those shares at any particular point in time. If you've got a bigger pool of people, household savings looking at trying to invest, that's started to push prices up. And a lot of the buying in some of these really really noteworthy stocks that made the evening news, the Afterpays of the world. I can remember reading certain reports at different points in time that there were a lot of on particular days the trading in some of these stocks through the likes of CommSec and more of the retail type trading outlets. So where you and I can just take $5,000 and go and buy some Afterpay shares or whatever it is that you might want to buy. There's more of these retail type trading platforms that they were actually controlling the vast majority of the volume in some of these stocks on particular days. So that just really goes to show the speed at which the ordinary everyday investor, somewhat punter, turned their attention to the share market, put some money in. So it wasn't the big institutions investing hundreds of millions of dollars at any one point in time. It was a lot of individuals spending small amounts of money. So I guess that's what's happened. We obviously dropped away. Markets have recovered very quickly thereafter. You can see just from here, and it comes through a little bit small on this share screen. It's bigger over here. But the ASX 200, one of the indices of the Australian share market, is only down 4% and a bit from where it was a year ago. So we have recovered very quickly. I'm going to go on at a limb and say probably a whole lot quicker than what most people had thought it would happen. But nevertheless, it did. So I guess where to from here, which was the whole point of this live stream that I wanted to go through. I would suggest that the easy money's probably been made. So share markets were always going to recover. They always do. I don't think too many people thought that they were going to recover as quickly as they have. A whole lot of government stimulus and a whole range of other reasons why, and I won't go into that today. But nevertheless, prices have recovered significantly. So where to from here? And I think it's the classic line. It depends. And I'll maybe frame this part of the conversation if I give you a couple of examples. So markets have recovered really well, which is fantastic. That's great to see. But where to from here, and what should you do now that your investments have gone up to the extent that they have? And that's really going to depend on who you are and what you're actually trying to achieve. Now, investing into the share market, investing into the property market, they're both just a means to an end. People don't invest into the share market to invest in the share market. They invest in the share market to achieve something. They're looking to try and achieve something, maybe tomorrow morning, something that's quite short term, or maybe something that's longer term. And so you need to start with, well, why did you invest in the share market in the first place? If you're a first-time investor, for those that had held their investments the whole way through, watched them drop and come out the other side, maybe it's something longer term you're trying to achieve. And if I use two examples here, I'll use myself personally and a client that I had a conversation with just yesterday. So an existing client of mine that's been through the down and seen it come up the other side. And the conclusion that we came to for both them and for me, very different. So if I start with them, it's a couple that have done very well through their working life, saving, investing, and they've got investment properties, a few $1 million in superannuation. They are very comfortable, very well set up. This whole multiple income stream, which I'll get into in another chat. But they watched investments drop. We have an exercise that we go through with all of our clients designed to kind of put some framework around what are you actually trying to achieve here. And so for this example couple that I'll give, it's about funding their retirement. They retired earlier than what most people would, with a whole lot more money than what most people would, because they've been very proactive over their working lives in building that up. But they're what are they trying to achieve is to preserve and maintain this capital for the rest of their retirement years. They've probably got another 20, 30 years ahead of them. So we go through an exercise to develop, what are the attributes of their portfolio that we actually really want to be achieving here, and that's different from them as it is from me, who's 20 or 30 years younger than what they are. So for them, there's some certain attributes around their portfolio, and right through all of this, we've been addressing those attributes. And what it meant is that as markets dropped away, they had a bit too much money sitting on the what we refer to as the defensive side, not quite enough on the growth side. They were were open to the idea of buying some more shares as things had dropped. Mina, as you say here, kind of, man, I wish I could go back. So we actually did a little bit of that. We held their positions the whole way through. We bought a few more as things had dropped away. And in the meeting I had with them yesterday, they'd made something like $250,000 since the 1st of July. Now they've got a few $1 million portfolio, so it's not surprising that it's gone up to that extent, given what's happened with share markets. But it's now at a point where the kind of the risk profiling of their portfolio is gone to another level. So I had the conversation with them to say, look, this is great. It's gone up. Fantastic. It's worked out well. But from where we are here, as I said earlier, I think the easy money's been made. You've now gone to, because of the growth we've seen in markets in the last couple of months, you've now gone to maybe another risk level, if you want to think of it that way. I think it's appropriate for you to actually start to peg this back. So for them, yesterday we agreed to sell about $100,000 worth of equities and bring that more back into a conservative portfolio, because the attributes of them, it's we're preserving this money to continue to support your lifestyle and your retirement for the next 20 or 30 years. Look at me, on the other hand, though, I'm working. I have many years ahead of me. My lifestyle is funded by me working, mortgages and kids and holidays and all the rest of it. So I went about setting up a small regular investment portfolio back in March or April when markets had dropped. I contribute $100 a week to that. Yes, it's done well. It's fantastic, but I've barely even looked at it. And that's the whole point. That's the whole point of the investing. I don't want to be looking at it on a day-to-day basis. I've got enough other things to worry about. But set it up, regularly invested, just as my super fund. My super fund is invested incredibly aggressively because I have many years ahead of me. It dropped away heaps during all of that. But, when I'm looking at it yesterday, it's just about recovered back to where it was before any of this happened. So I've been working, contributing, and continuing to add to that. So me and my circumstances and what I'm looking to achieve with my investing, I'm not selling any of my investments. So it was more than appropriate for this couple that I was speaking to yesterday to actually bank some of what they've made. For me, as much as markets have come up and maybe they drop me going into the future, who knows? It's continuing on that trajectory. So you need to understand, as I said, or you need to give some thought to what are you actually trying to achieve by you investing, whether it's you're buying a property, whether you're in the share market. No one does it just to make money. That money is for a particular purpose. What is that purpose? If it's buying your first home, you've dabbled in the share market in the last few months, you've made a fair bit of money, but ultimately you're looking to buy your first home. Well, maybe you might want to consider taking some of that money out. But the big kind of asterisk there for everyone is understanding the tax implications. For those that aren't aware, when you buy shares, property, these types of assets, any gain that you make, that you realize within the first 12 months of holding that asset, is taxable at your full, at your full rate. So if you bought something, sold something, and made a $10,000 gain, that $10,000 gets added to whatever other income you might have from work or wherever else it comes from, and you're taxed at your ordinary marginal tax rates on that. Whereas if you held those investments for a year, you're only taxed at half that rate. So there are some tax savings to be had by holding those investments a little longer than you may already have if you're a first-time investor. But be mindful that prices might not be quite so high as they are today in another 6 months' time. Maybe they're higher, maybe they're lower, maybe they're exactly where they are. that's what happens with investing. No one really knows what the future is going to hold. So I hope this chat has been some value to some of you, whether you're watching it live. I think there's been a few of you kind of jumping in and out. David, I can see you've caught the end there. So thank you for joining me also. Hopefully that's been useful for you. We have, markets have come up a long way in a very short period of time. November was an amazing month. The Aussie market was up nearly 10%, which is fantastic. We are seeing some great returns. But to what purpose? What is the purpose of those returns that everyone's been chasing? And is now the time maybe for you to reconsider doing something different? Maybe it is. As I was saying with my client, for me, it's not. Continue on the journey. With shares, don't you receive a payment each year for a gain? No, you don't. So if I was talking about Afterpay. If I bought Afterpay shares and I just held them forever, Afterpay may well pay me a dividend, pay out part of their profits to me as a shareholder. But if I don't sell my Afterpay shares, well, then I'm never taxed on any gain. It's only when you sell them. If you're in a managed fund structure, that's different. They pass out some of their gains on an annual basis to you. So there's some annual tax obligations that are going on there. But if you're, as a lot of first-time investors did, set up a CommSec account or any number of the others and put a bit of money into some of these businesses that have been flying, unless you sell them, there's no gain to be paying tax on. So that's it from me today. Hopefully you can join me tomorrow for December daily number 2. Tomorrow morning I'll put a post on my LinkedIn and my Twitter when I'm planning to go live. Hope you can join me. I'll call it an end to today. I do have a client meeting in 9 minutes. I better run and prepare for that. So thank you all for joining me. If you're catching this on the replay and you've got any questions, do reach out. And if anyone is out there and would like to join me on an upcoming chat, by all means, you're more than welcome, rather than just me sitting here in a room talking to a computer screen. So see you tomorrow. Thanks. Bye.